What's up, everyone? Dylan here. I wanted to hop on to do another episode of the weekly analysis video. As always, I'll be talking about what's been going on in the market, as well as some of the key areas that I will be assessing price action around going forward. With that said, we'll hop right into it. So, to rewind to last week, I talked about how the S&P hit a critical trend line and it bounced very, very nicely off of it, and that bulls had a real shot at presenting a relief bounce. Going forward, I said that it was going to be very, very important to assess price action around the 50-day moving average on the cash index, as I believe that that was going to be a potential area where sellers reload at. Unfortunately, as you could see, Monday's high did not get up to that 50-day moving average. It missed by about 10 handles. So ideally, I would have liked to see the price action right at that area or above it and see, what happened around that, but it didn't quite get up there. So, what I expected was close to happening, but what I didn't expect is for the S&P to sell off an additional 5% from Monday's highs to Friday's lows. Okay, that shocked me. The reason it shocked me was because some of the things that I went over last week, right? We went over how the market was very, very oversold on multiple time frames on the macro, visual. We went over how there was such extreme greed looking at the CNN gauge. We looked at, some of the indices as well as individual equities coming into key areas of support, right? There were multiple things that I went over last week that, not only was I looking for a relief bounce, but at least was looking for the market to kind of take a breather. So to see that it went from peak to trough again, another 5% and continues to sell off each week over the last 3 weeks, and the fact that out of the last 12 days in the market, the last 12 sessions in the market, 10 days have closed red, right? These are the things that I did not expect, right? The caliber of the recent move that we have seen. In fact, the Nasdaq reached and entered, I should say, correction territory, which is 10% from recent highs. So correction territory, right? An instrument or index, stock, whatever it may be, when it drops 10% from recent highs, that is known as correction territory. So from the highs that it made 3 weeks ago to Friday's lows, it dropped as much as 11.5%. So, it's very, very clear that the market continues to sell off and at a pace and rate that, that exceeded what I believed to, be the case or exceeded what Dylan thought would happen. Okay. So why have we been selling off? Goldman Sachs put out a note, their trading desk highlighted 10 different reasons as to why the market has been moving lower. I'm just going to go ahead and read a few of those. Slowing growth concerns, tariff implications, weak technicals, systematic supply, which is just CTA, selling pressure, elevated positioning, low liquidity, poor seasonality. Okay, so they go on, but those are just a few factors that are leading to the weak price action. So where are we now? Okay, I wanted to point out a key technical area that I mentioned in the Discord, and then going forward, we'll talk about where we're at now and where I expect price to revisit in the future. So let's go to the Discord, and you could see on Thursday, I said no trades on my end, right? For the whole week, I didn't take a single trade in the equity market leading up to that point. The last 2 trades I took were the previous Thursday and the previous Friday, which were the February 27th and February 28th. So from February 28th to March 6th, I had not taken a trade in the equity market. By no means did I not see any bullish technicals, right? There was a ton of bullish technicals despite the fact that the market continued lower, right? We saw multiple different rallies that occurred from Monday to Friday. So there were some mixed pieces of context and just overall difficult to read price action in my opinion. So as you can see, the next time I may try a counter trend long is if the cash S&P hits 5672-ish. For now, price action is tougher to read as near-term trends are short-lived. I cannot short into the 200-day moving average, which hasn't hit in well over a year. Probability just isn't high for my style. Okay, so basically I was saying that price action was all over the place. I didn't have a good read, and the next time I was looking to take a long was if and when the cash S&P hit 5672. And then the next morning at 9:21 a.m., I said the same thing. The next time I may try a counter trend long is if the cash S&P hits 5672-ish. So let's go ahead and look at that cash S&P. 5672 happened to work very, very well. Okay, this is a macro visual. This is the daily chart, and as you can see, the reason I was looking at that area of potential support was because it was previous all-time highs, and then once it broke out, it then acted as some nice support on the retest. So with, a combination of oversold technicals, extreme fear, and heading into a very, very, very important macro support, I believe that the probability was high to try a long there. On top of that, the Nasdaq was also coming into a key critical trend line as well, and it ended up testing at the same exact time that the cash index tested 5672, which made the probability even higher. Okay, so oftentimes, especially in the Discord, I'll talk about the timing aspect, right? Anyone that's watching this can draw lines and support resistance and zones on a chart. Okay, what separates me from a lot of other people or a lot of other technical analysts is the timing aspect, right? I'm very, very good at aligning different pieces of timing into key technical areas, and this is a prime example. So if we go to a 5-minute chart, you can see that the Nasdaq came into that critical trend line right around 1140 and continued to hold there from 1140 a.m. to 1220 p.m. So about 40 minutes of absorption down there where all the different selling pressure into that critical trend line was being defended by the bulls. So again, 11:40 a.m. to 12:20 p.m. And I'm going to just, for time's sake, I already put the 5672 equivalent on the S&P futures. And if you look at the timing, when did it first test? 11:40 a.m. Until 12:20. So the S&P and the Nasdaq were at those key areas that I was watching at the same exact time. And like I said, they had oversold, pieces of context were oversold. The fear was there, and multiple other pieces of confluence as well. But those were the actual lines that I really, really used as my line in the sand. And the reason that I took a trade there as opposed to all of the other days is because not only because of those key macro lines that lined up on the S&P and the Nasdaq, but also because the risk reward was so appealing, right? Basically what I was looking for was S&P to come into that 5672 level on the cash index, right? We're just going to look at the S&P futures. It came into that area, and then I didn't get in right at that area, right exactly at that level. I wanted to wait to see if that general area held. So I didn't get in until 5691 on the S&P futures, which was about 18 points after the low had been put in. So I was essentially risking 20 points to make, a lot more in terms of projected reward. So this worked very, very well. Now, more importantly, where are we going, in the future? Where do I expect this move to go going forward? And very, very importantly, I wanted to go over some of the newer pieces of context to kind of follow up with what I went over last week. So a lot of the context from last week still stands, right? The RSI is still oversold, right? We go to let's say like the 4 hour, right? The 4 hour is a nice positive divergence on the RSI, still in the oversold territory. The SPY and QQQ also hit the oversold territory as well. And, from last week into this previous week, we were in oversold basically for the majority of the week. So all of those pieces of context still stand. The fact that the CNN gauge was still in extreme fear and got even worse from week over week, that still standed, or that still stood. And then going forward, we have additional pieces of confirmations as well. First off, I wanted to talk about seasonality, right? What is this, Kobisi letter? They have a newsletter. They posted on Twitter that Trump tariff war 1.0 and 2.0 are very, very, very similar, right? The first Trump trade war proved to be an exceptional buying opportunity, as shown below per Zero Hedge. Markets are trading on nearly the same exact route right now as they did during the first Trump tariff war from his first term of presidency. So you could see, like I said, like they said, very, very similar path. And from his first presidency, the market, the S&P was able to stabilize and bottom. It looks like in the second or third week of March is when the bulls stepped in, and that's exactly where we're at now. On top of that, we also have a seasonality chart from Equity Clock. They post a lot of seasonality charts amongst indices and individual names as well, which I find to be very, very helpful. And as you could see here, from 50 years, right? So call it 1970s to this chart was from early 2024, so it's a little outdated, but still, over the last 50 years, the market tends to bottom around mid-March, where it tends to go higher from there. So March is one of the strongest months of the year for stocks, with the S&P 500 index rising by an average of 1.1% and gaining in 66% of periods over the past 5 decades. So that's exactly where we are. So that's another piece of confirmation that is essentially backing up the overall speculation that the S&P should head higher from here. On top of that, there's also, this was from Goldman Sachs, CTAs, which I told you guys was one of the reasons as to why Goldman Sachs trading desk blamed on the recent weakness over the past 3 weeks. However, going into this next week, the technical supply will be largely finished, by tomorrow. So basically, they say that CTAs, which is just algorithmic trend-following programs, have sold $47 billion worth of global equities in the last week. Okay. So $40 billion to sell, 1 month flat tape, $43 billion to sell, right? The fact that the flat tape sell expectations over a month and over a week are almost the same means that with spot here, right, with the S&P here, this technical supply will be largely finished by next week, which is, starting today, tomorrow. So that can free up a lot of the selling pressure that we have seen in terms of, algorithmic CTAs, which essentially can take some pressure off of the S&P and allow it to sustain value on pops because very, very simply put, every time we have rallied in the S&P, we have not rallied for more than one day, right? There has not been 2 consecutive green days since February 19th when the S&P and the Nasdaq made all-time highs. Okay, so since then, there has not been 2 consecutive green days, which literally means that the sellers has been so strong in where they reload on relief bounces higher. So removing that that factor of CTAs, their supply that they have left, or dry powder that they have left, could allow for potential rallies in the S&P to at least to sustain value for more than a single day. In theory, right? That's an assumption, but it certainly it certainly helps the cause for bulls is all I have to say. So those are 2 different pieces, or 3 different pieces, 2 for seasonality and 1 for the fact that CTA supply is drying up, that we didn't necessarily have from last week's pieces of bullish confirmations that can help the bulls going forward. So where do I expect the market to head in the near term? Okay, very, very important. I want to go ahead and talk about the critical trend line from last week that I went over. So it ended up breaching this past Monday. And then since then, that's been a key area where the sellers have reloaded at. As you can see, Tuesday's high coincided right at that retest. And then again, Wednesday, it did not necessarily test there, but it got pretty damn close on Wednesday's high as well. So going forward, if this bounce can continue, this general area will be very, very, very important to assess future price action at. And ultimately, this is an area that I would not be surprised to see sellers reload at if tested. On the flip side, if we don't get up there, right, the 2 areas to watch to the downside are the 56.72 equivalent on futures is 56.80-ish, right? And the NASDAQ trend line that stems from October of 2023 or October of 2023. Okay, so both of those lines are very, very important for the bulls to defend going forward. Okay, however, if this move to the upside can really stabilize, right? This is what I said in the Discord. I said, if price manages to hold that general area, that could be an area that changes near-term sentiment from selling the rip to buying the dip. So if that holds true, where because we held that area, the bulls are going to manage to now buy the dip and ultimately push price up to that critical trend line retest again, that would be my next key area to look at. Hopefully that's very clear. Okay, so I've talked about the S&P and the Nasdaq. I also wanted to talk about Tesla because Tesla has been getting smoked. Tesla, from all-time highs, which were December 18th, right, just less than 3 months ago, has dropped almost 50%, which is a crazy move. And I talked about this last week, but the RSI continues to be in oversold territory, and it still is struggling to bounce. However, I pointed out a key area that I was looking at entering a position at. First off was the gap fill. Not only was this a normal gap fill, but it was the gap fill from the election, the presidential election, that essentially, once that gapped up from the presidential election results, that triggered a massive rally to all-time highs, which was about 70 75% from lows to highs, which is a very, very significant move. So we just filled that presidential election gap, which should act as a pretty solid support. On top of that, we also retested a trend line stemming from November of 2021. So this general area was an area that had two overlapping pieces of support, technical support, as well as the fact that Tesla remains in oversold territory, which basically implies that an area of support will have a higher probability of working. And if we go to the Discord, I said on Thursday, I said looking to swing some calls when Tesla hits 255.28, which is the gap fill and trend line retest. And then I said I'll distribute my risk across 3 different contracts, which I entered on Friday. So I also, not only do I expect the S&P to have at least a relief bounce going forward, but also for Tesla to kind of stabilize and hopefully have a near-term or medium-term bottom from Friday's lows. So we'll see what happens. But I appreciate all of the support. If you like this video, give it a thumbs up. Feedback is always appreciated. And hopefully I do not get surprised again with the S&P selling off another 5% this week. That would really, really make me mind blown. So 2 weeks in a row, it's been very, very difficult if you're a bull, but hopefully the 5672 line marked a near-term or medium-term bottom. So fingers crossed, but we'll see what happens. I'll continue to follow my plans as always, and hopefully this video was helpful. Peace.